Assalamualaikum warahmatullahi wabarakatuhu. Welcome to my virtual classroom, MKA CLASSROOM. Now let's start today's video tutorial. Today we will start bond valuation. Firstly, we will try to discuss what is bond, what are debentures, or what are bonds. Actually, bonds are long-term fixed income securities. Long-term fixed income securities. Debentures are also long-term fixed income securities. These are also fixed income securities. Both of these are debt securities. Debt securities. Debt securities. Both of these are debt securities. The debt securities issued by the government and public sector units generally referred to as bonds, while debt securities issued by private sector joint stock companies are called debenture. So it is simply whenever a debt security is issued by the government and public sector units, this is treated as bonds. Bond or bonds. While these debt securities are issued by private sector joint stock companies, these can be treated as debentures. These two terms, however used, are interchangeably. Bonds are generally two types. One is government bond, another is corporate bond. Government bonds represent the borrowing of government. Since they are backed by the government, they are considered free from default risks. On the other hand, corporate bonds represent debt obligations of private sector companies. Corporate bonds are backed by the credit of the issuing companies. It is the company's ability to earn money and meet debt obligations, and that determines the bond's default risks. In the case of bonds, both the cash flows streams, interest and principals, and the time horizon, that means maturity, are well specified and fixed. This makes bonds valuation easier than stock valuations. Only several problems creates only callable bonds and convertible bonds. These are the special issues in bonds valuations. In the case of callable bonds, the bonds may be called for redemptions earlier than its maturity date. So it should be callable before the maturity date. That's the callable bonds. As the right to call rests with the companies, callable bonds must offer a higher interest to compensate for disadvantageous calls. That means the company calls that bonds before its maturity. Another is convertible bonds. Convertible bonds are those that can be converted into equity shares at a later date, either fully or partly. That means the bonds can be converted into shares, fully converted, or partly of bonds can be converted into shares. These are the basic introductions of bond valuation models. Then we will try to see several terms that are frequently used in bond valuation model. Then we have to have clear idea about that terms. We have to have ideas, then it will clear to understand the bond valuation models. First one, face value. Face value, bond has a face value. Face value means the value which is the at time of issue of that bond, or the amount which is written in the face of bond, that is actually the face value. The value which is written in the face of a bond, that is the face value. As like when you see a taka in your wallet, or in a dollar from your wallet, you see at the corner of the dollar or taka there has a value 5, 10, 100, 500, 50, etc., etc. That's actually the value of that bond. That bond is called the face value. After that we will see maturity value. Maturity value, that means whenever the bond is mature and the company will give you a fund, give you several takas which is equal to the face value. That's the maturity value. So you know that actually bond has a riskless gain, one kind of riskless gain, because whenever you hold the bond, then you will get the interest whole the term, that's you hold it, and after the maturity you will get your investment amount. That means I am going to saying that suppose you purchase a bond taka 1000 today, and this bond will give you annual interest of taka as like 10%, annual 10%. This interest rate is called actually coupon rate, that will provide you 10% to its maturity, such as maturity year we will see as like it matures after 10 years. It matures after 10 years. That means each year this company will give you 10% into 1000, that means 100 taka to you for 10 years. And after 10 years you will receive this 1000, that is the maturity value, and this 100 100 taka is called coupon, which is giving you each year for 10 years. That's the coupon or coupon payment. Someone says it's the coupon payment. And maturity value, that means at the end of maturity period, that is the maturity period. At the end of maturity period, it gives you its face value. That means whenever you purchase this bond with the 1000 taka, that's called the face value. And after 10 years, that is maturity, after the maturity period, that company will back you this 1000 taka, that is the called the maturity value. And at the 10 years it is giving you 10% interest, that is the coupon rate. 10% shows 100 taka, that is called the coupon. That is the basic terminology of bond valuation models. So it sometimes provide you yearly interest and sometimes it provide you semi-annually interest. Whenever it provides the semi-annual interest, it will give you 50 taka at January and 50 taka at July. That's the semi-annual interest. So semi-annually it will provide you 2 times coupon in a year, that is 100 taka. After that we will see current yield. That means the current yield measures the annual return according to a bondholder who purchases the bond from the secondary market and sells it before maturity, presumably at the same price at which bought the bond. And then now we are talking about the current yield. Actually, the current yield measures the annual return to a bondholder that who purchases the bond from the secondary market and sell it before maturity. So current yield has a formula. We know that current yield equal to interest divided by current market price of shares into 100. That is the formula. We know the current yield formula. I means annual interest, P naught means current market price into 100. The current market price of a bond in the secondary market may differ from its face value. It is clear? So current market price may be differ from its face value. A bond of face value 100 taka may be selling as a discount as like 90 taka, or may be selling at a premium 115 taka. So as like we have said in here that here we discussing about 1000 taka. So in the market, that means current market price of the bond may be differ. It may be sale at the discount rate, that means 900 taka, or it may be sell the premium or 1100 taka. So that may be change over the time. Now if we see an example, then it will clear to us. Suppose I am telling that suppose if a bond of face value 1000 taka and a coupon rate 12% is currently selling 800, so what would be its current yield? So we see it says the face value has the 1000 taka and coupon rate has 12%, and currently it is selling in the market, that is P naught, that is currently selling in the market 800 taka. What is its current yield? So we know that formula, current yield formula, annual interest payment divided by current market price. So annual interest payment, what would be its annual interest payment? 12% into 1000, that means 120 taka its annual payment or annual interest, and current market price is 800 into 100. If you provide 100, it is clear or not, no problem. So it shows the result 15%. That means if the investor purchases this share from the capital market with the 800 taka and receive at its maturity 1000 taka, and he will get 15% is his return. The current market rate would be higher than the coupon rate when the bond is selling at a discount. In these examples, if the current yield would be higher, current yield would be higher than the coupon rate. Here is the coupon rate 12% and our current yield is 15%. So here said that current yield would be higher than the coupon rate when the bond is selling at a discount. So in our example shows that in the same way current yield would be lower than the coupon rate for a bond selling in premium. So we know that the discount bond and premium bond. So discount bond, what is this? Whenever the bond is selling below its face value, that is the discount bond, and premium bond which is selling more than its face value, that is the premium bond. We know it better. Now we will see spot interest rate. So a spot interest rate, actually it is for the zero coupon bond. That means the bond which is not paying any kind of interest to you, that is the zero coupon bond. So zero coupon bond is a special type of bond which does not pay annual interest. The return on this bond is the form of a discount on issue of the bond. So the discount bonds return is from the sale of that bond. So we know that if we see the example, then it will clear. Face value of a bond is 1000 taka, but it sells in the market 800 taka, but at the time of maturity, as we say, that is the maturity period is 2. Maturity period is 2. We say maturity period is 2. That means 2 years. For an examples of a zero coupon bond, it will not pay you any kind of interest, but it sells in the market at discount rate. That's why we will purchase. So such as the examples, zero coupon bond, it has the face value 1000, it is selling to you 800 taka, and after 2 years you will receive this 1000 taka. This 200 is your return by the investing in this zero coupon bond after 2 years, not now, after 2 years. So that is the zero coupon bond, which will not pay you any kind of interest. That means no coupon or no coupon rate. That's the zero coupon bond. Then this type of bond actually called pure discount bond. Pure discount bond, remember that, pure discount bond or deep discount bond. Pure discount bond, pure discount bond or deep discount bond. Deep discount bond. The return received from a zero coupon bond on a pure discount bond expressed on an annualized basis is the spot interest rate. That means whenever you receive after 2 years this 200 taka, then what type of interest you have earned actually is called the spot interest rate. We are talking about a spot interest rate. Actually this is our spot interest rate, which we have actually returned from our investment. So that is our investment. Our investment is 800 taka. After 2 years we will get 1000 taka. So what type of return we have earned from this, from our investment? Actually this is called the spot interest rate. So it is very easy to calculate if we put out the formula as like future value or present value, then it will show our result. That is the future value, that is the present value, then that is our ends value, then it will show the result. As like if we use the present value formula, formula equal to, sorry, we will use future value formula. That will very easy for us. Future value formula, AV equal to PV1 plus R power n, or you can use the present value formula, no problem. Present value equal to future value divided by 1 plus R power n, no problem. Whatever you like, you can use this formula. Here you use K, no problem. Here is use I, no problem. Here is use R, no problem. All are related to the rate of interest. Actually here this interest is called spot interest rate. So we our present value we have said 800 taka, our future value 1000 taka, and 1 plus R, we do not know the value, and n equal to 2. Then if we interchange the matters, then we will get cross, then 800 into 1 plus R power 2 equal to 1000. Then we will see 1 plus R power 2 equal to 1000 divided by 800. Then what will the result? The result, whatever, doesn't matter result, we will see result 1000 divided by 800, that means 1.25. Then 1 plus r equal to 1.25, that should be interchange 1 by 2, that is a 1 plus r. So here we will see 1 plus r equal to 1.25 power 0.5, that here we will see 1.1180. So r equal to 1.1180 minus 1, that means r equal to 0.1180 equal to 11.80%. That is our spot interest rate. That means from our investment we earn 11.80% our return or interest from our investment. So if we purchase this zero coupon bond with 800 taka and hold it for maturity period is 2 years, and after 2 years we will receive 1000 taka, and our spot rate is 11.80%. that is the spot interest rate which will relate to the zero coupon bond or purely discount bond or deep discount bond, that means which we earn from our investment one pure discount bond. The return received from a zero coupon bond or a pure discount bond expressed one as annualized basis is the spot interest rate. In the other words, a spot interest rate is the annual rate of return on a bond that has only one cash inflow over to the investor. In the other words, a spot interest rate is the annual rate of return on a bond that has only one cash inflow to the investor. Mathematically, a spot interest rate is the discount rate that makes the present value of the single cash inflow of the investor equal to the cost of the bond. That means we turned it to its present value. So we will mathematically say spot interest rate is the discount rate that makes the present value of single cash inflow to the investor equal to the cost of the bond. In the other word, the cash inflow from the bond when discounted with the spot interest rate becomes equals to the cost of the bond. This all about today. Stay home, stay safe. Assalamualaikum warahmatullahi wabarakatuhu.